Everyone, it's Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Taking a look at the market today, you can see that we did have a pretty significant move to the upside today. So we'll be talking about that. In addition, the stocks that you see on your screen, we'll be covering those throughout this broadcast as well. And remember, if there's a particular stock that you're interested in, you can go directly to it using the chapters feature in the video rather than just watching through the entire video. So with that said, let's go ahead and get back at the chart of the S&P. Big up day in the market today, which is really quite interesting. If we go back and look at what happened on Wednesday, we did have a little bit of a move to the upside, and that was on the ADP jobs report that came out. Now, that's the private sector jobs report, and it showed that basically half the jobs that were expected were created, meaning that it's kind of showing a little bit of a cooling in the jobs market, and perhaps that gives the Federal Reserve a little bit of a chance to exhale here, maybe not be quite so hawkish because they've been so intent on cooling the jobs market. Wage inflation, etc., has been a problem with them. So we finished to the upside on Wednesday. Then we had yesterday's move, which was kind of a sideways move, and then today. And in today's move, we had the non-farm payrolls report. Now, that's the government's jobs number. So the non-farm payrolls report comes out and is the exact opposite. Basically showed twice as many jobs were created as expected. So you have the ADP report, which is private sector, showing half the jobs created. Then the government's number comes out showing twice as many. Those two things don't jive. Now, it's often that the ADP report and the government's non-farm payrolls report aren't in sync, but it's usually not this big of a disparity. So it kind of makes you wonder, is there's a little bit of game playing with the government's number? We're heading into an election, etc. They don't want to show that the jobs market is cooling off. But the market opened to the downside. You can see on the bar here, we opened much lower and then took off and traded and closed near the high of the day, which was a little bit of an unexpected move considering the concern when that non-farm payrolls report came out. The futures were kind of flat. Then that report comes out and boom, they tank and we open lower and then we rally throughout the rest of the day. Perhaps it's just the fact that, as we've been talking about, there is some support here at the 420 level. The wave 4 in this 5-wave Elliott wave pattern is right at the 50% corrective move. Not surprising that we might try to bounce here. In fact, I've been saying that if we're going to bounce, this would be a pretty good time to bounce off that 50% corrective move, and the fact that 420 has been resistance for quite some time, going back into the previous year. Then we broke above it in June. Now support. We had not tested it yet. We have now tested 420, bouncing above it. Can we hold that? Can we continue higher from here? That's going to be the big question going into next week. Note that we were able to close above the 10-day moving average, which is that lime green line. So that part all looks pretty good. So we've been pretty kind of spot on what's been going on here. And if you like these videos, please hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of these videos is posted. And we do a live show on Fridays at 2 p.m. Eastern time over on the Hub Financial channel, also in YouTube. So head over there if you like these, and you can get involved with our live Q&A. We do it for roughly about 30 minutes on Friday afternoons, but you need to be a subscriber over on the Hub Financial channel. So bouncing off of 420 today, above the 10-day moving average, that's the important thing. Can this wave 4 hold at a 50% correction? The possibility does exist. Now, looking at the TNX, the 10-year, this is a point of concern. you can see that we're in a wave 3 here. Now, if we walk back, and that's one of the really cool things about this software. If you're not familiar with the software, it's from the Hub organization, hubb.com. That's who we do the live show with, Hub Financial. It's the best Elliott Wave software program that exists, in my opinion. I've tried all the ones that I know to exist. This one's programmed exactly to the Elliott Wave algorithm as Ralph Nelson Elliott himself wrote it. It's not a personal adaptation of the algorithm. But if we go back, you can see that we had a wave 5 in the TNX, and I actually had done some work on the bond market and thought we looked a little toppy. We had that gap up right here. We'd gone a little vertical, thought maybe we're going to try to go a little sideways here, which we did for a short period of time. But then look what happened. We relabeled to a wave 3. We talked about this in Tuesday night's TradeFinder. And by the way, if you haven't signed up for TradeFinder, please do so. You can see the link on your screen. We do it every Tuesday night at 9 p.m. Eastern Time. We talk about the markets. We look for trade ideas, and we have a live Q&A there as well. So we talked about how the fact that the wave 5 is relabeled to a wave 3 could really be problematic for the markets moving forward. So we had a little bit of a reprieve today in the markets, but that's scary with the fact that we're looking at 5.2% is where that wave 5 target is on the 10-year. Now, when you're in a wave 3, just a quick reminder, this 4 here does not mean the wave 4 is underway. It means if the wave 4 was to start today, that's about the area you could expect to have support. And for whatever reason, the algorithm itself, not my numbers, but the algorithm that Ralph Nelson Elliott created, 30 pages of coding, shows that for whatever reason, it likes that 5.3% level on the 10-year. So we could have a bit of a correction in rates first and then move up there, or we could have a run from the wave 3 to that level first before we have a correction. Either of those are possible when you're in a wave 3, especially when you've had one that's relabeled. So that's the kind of thing that we talked about Tuesday night during TradeFinder. So if you're a little bit nervous on the markets, this isn't helping as far as creating a little more anxiety based on what the market's done in the correction. What's it going to do if we break above 5% on the 10-year? Looking at the dollar has given us a little bit of a reprieve here. Not much, but a little bit. But look what's happened there. We've labeled that chart now. Remember, last week we didn't have a 5-wave pattern labeled on the dollar. Now it has, and it's also in a wave 3. So when you couple the 10-year relabeling from a 5 to a 3, and then you have the dollar labeling to a 3. And by the way, I wanted to make a quick comment. A lot of times people say, oh, yeah, this relabeling stuff, that's why I don't like Elliott Wave, because it relabels. I view it the exact opposite. Markets are dynamic. They're ever changing. And if you have an indicator, technical indicator, that's slow to respond, you can have real problems. Losses in your positions. You want indicators that are quick to respond if the market changes its tone. So when we have things that occur in the markets that are slightly different or changing, that's one of the beauties of Elliott Wave, in my opinion, is the fact that it's so quick to respond. So labeling this wave 3 in the dollar, relabeling from a 5 to a 3 in the TNX. I know we had a nice bounce today, but gosh, we'll have to wait and see if we get any follow through next week. I'm still a little concerned about where we can go based on those. The dollar going up, interest rates going up, is going to be very difficult for the equities market from that point moving forward. We'll see how that plays out. Looking at the DIA for the diamonds, also bounced. You're going to see the theme as we go through and look at the different U.S. markets here. We had this little bit of support here at 340. We went right through that, the old cliche, hot butter through knife. Or hot knife through butter, I should say. We didn't have any sort of a bounce, just boom, right through it. And so we got a little bit oversold there. on the DIA, and notice where we closed today. Exactly on that 10-day moving average, the lime green line. I wouldn't be surprised to see us come up and test 340 due to the fact that we just sliced right through it. 340 had been the support resistance line going back for basically the entire year. You can see even into October of last year, it was resistance. So it's been a support resistance line. It was resistance all the way till we broke above it there in the June-July time frame, and we just went right through it. Normally, when you break a major point of support resistance like that, you get a test of it. So perhaps we get slightly more to the upside here, but then I'd be cautious if it makes it to 340. Can we get back above 340, or are we simply going up to test that old support and new resistance line? Looking at the Qs have been really impressive to me. As you'll note, as we go through and look at the different markets, look, the S&P had a 50% correction, spot on. The DIA down here at 70%, but then we look at the Qs, and they've only corrected 28%. And Elliott himself barely viewed that as a correction. He wanted to see at least that 38.2% fib level for a correction. I am really surprised that the Qs have held in there this strong with rates and the dollar moving as high as they have. So the AI play, and we're going to look at some of those stocks and stocks of interest here in a few minutes, but the AI stocks are really driving the Qs, I think, to hang in there. And looking at this, we pretty much just came down to this area of support around 360, and we held it and broke up. Now, the only negative here is today we filled this here. We talk about this all the time. Gaps get filled. Our data shows that 94% of gaps get filled, but we don't know exactly when. Sometimes sooner, sometimes later. So we just filled the gap today. Going to get follow through on that move to the upside, back above 360. Now the concern, and I think this would be really telling and massive negative note for all of the markets in general, is if we don't hold this 360 level, which we have so far, if we get a significant break, look, the move from 320 to 360 was just straight up. And that means that if we break below 360 meaningfully with follow through, we probably come back down to 320 just as fast. We're not there yet. And so I'm not trying to suggest that that's going to happen. I'm just saying it's something to watch for. As of today, rest easy. If you're long the Qs, you have a good weekend ahead, and then we'll wait and see what happens next week. But you do have to be impressed, regardless of where you believe the Qs are going to go, on how well they've held in. It really has been impressive. Now looking at the IWM, much uglier chart. And you can see we had this big zigzag. There's zigzags everywhere. We talked about that last week, so I didn't really want to get into it too much this week. Look at last week's recording if you're interested in it. We broke below that 100% extension. We came back up to test it today as we held that level at 170. If you've been listening for quite some time, you know that for a long time, 170 to 190 has been the trading range of the IWM. We had broken above it and gotten to 210. We haven't been there in a while. We did have this little reprieve here in July where we tried to get above 190. Other than that, it's been in the 170 to 190 range. So we broke below that 100% extension, but we held 170. Can we hold that? Remember that with a roughly 61.8% B-wave correction, the 100% extension was the target. So we broke a little bit below that, which makes you wonder, are we going to go to the extended level, which would have an IWM number around 165? That's possible, but at least for today, 170 held, and we had a break back up. But even on that move today, note that the high of the day, the high of the day on the IWM just touched the 10-day moving average. So let's not get too excited too fast. We could see 161.8% extension on the IWM. Now, an interesting thing that came up last night in our insiders meeting, and that's for our alert subscribers only at ewotrader.com. We send out alerts for entries, any adjustments, and exits when we find stocks that fall within our parameters. And in our insiders meeting last night, somebody asked the question, could 100 be in the cards for the IWM? And the reason for that is when we look at this, you can see that if we were to break 165 on this IWM, there is nothing, absolutely nothing below it. Where would the IWM go? I don't know. In general, it just feels like 100 might be a bit too low. If the IWM sees 100, then as I've been saying, if things get really ugly, all hell could break loose. I just don't feel like that's going to occur. And that's because I don't feel like the Fed would let it get that bad. They've let things get a little dicey here, let the market correct. I think they're willing to accept a little more to the downside in the markets. But I do think there's a point where the Fed would step in, start cutting rates, and we wouldn't see anything that nefarious occur in the markets without the Fed starting to ease monetary policy. Right now, they're raising rates and withdrawing liquidity. So and I go back to this chart of the dollar, and people wonder, how long can we continue to do this? How long can we continue to go in debt and just keep printing money? And you look at this trend channel here on the dollar, and it's a pretty tight trend channel. Well, that's the answer to your question. As long as we can continue to go to the upside in the dollar, like right now, apparently there's global concern, and the dollar is viewed as the currency of last resort. As long as that's in play, that gives the Federal Reserve freedom to ask the Treasury to print as much money as they want, and we continue to go into debt. And until that changes, and who knows if or when that'll change, the Federal Reserve can continue to just print more money and create more debt. Whenever this changes, if it ever changes, that's when we have to see something get significant. I talked about that both in Tuesday night's TradeFinder and last night. I don't know that that'll happen in my lifetime. Maybe the next generation. At some time, we'll see when the piper has to be paid here, and that's when it comes to roost of all this debt that we're creating. But it hadn't happened now, and the dollar being that strong is telling you it's not going to happen anytime soon. All right, so let's take a look at some stocks of interest, and we do look at all of your comments on our YouTube videos. And as a quick reminder, we are looking for a push to 40,000 subscribers, and when we get there, we're going to give away 4 of our level 3 trade alert services, and that accounts impulse strategies, which are directionally based, and the volatility strategy, which is triangles looking for breakouts, and our AI-based time strategy. All are included, so thousands of dollars in each of these alert services that we're going to give away if we get to 40,000. And all you have to do to become registered is post a comment. And so we do read your comments and continue to do that. I know a lot of you are saying that I'm posted, I'm in. Ask your friends, colleagues to do it. Let's get to that 40,000 level so we can give those subscriptions away. All you have to do is go to our website at ewotrader.com and see what the performance is. I think you'll be impressed. Looking at Tesla, there was some news out, and as we knew, Tesla had closed some factories. Pretty surprised that we haven't had more of a corrective move on Tesla, but look at this triangle going into earnings. And earnings coming out on Tesla on the 18th. They kind of told us that production has been down, and we knew that. Elon told us that because they were shutting some factories down to upgrade them. But is it going to be much worse than expected. It was announced today, and that's kind of why we had this little bit of a bounce up, which was interesting that Tesla was cutting the prices on some of their cars due to the fact that there hadn't been as many sales. Is that a precursor to a really negative earnings report? Could we break to the downside out of here? According to Elliott, you never want to get in front of one of these triangles, regardless of what the Elliott wave pattern is saying. And it shows a wave 4 right there at that 61.8% fib level. So your thought would be, hey, we're going to break to the upside and move to the wave 5. Maybe we do, but you don't want to jump in and guess on that because triangles can break either direction. So we'll see what happens when Tesla reports earnings. It's a pretty interesting earnings play with a really nice triangle that we've talked about before. Stocks of interest today, RIVN, we had RIVN, which showed up. A lot of people were interested in that. Now, what happened here today is they issued a bunch of convertible notes. Issuing debt that can be converted into shares has the potential to dilute the float. That's why we had this big move to the downside yesterday. And when we're coming down here, you would think, gosh, we're probably going to come down and fill this gap. So you go back to the 30th of June. The high that day was 1675. The low today was 1765. So we haven't quite filled the gap. You would think that there's probably a little more to the downside to go here on RIVN, and anything that they do to dilute the float is never positive for the equities price. And basically, they're raising money. It's kind of interesting that somebody would do something like that in this environment where rates have gone to the upside. So it does reek of maybe there are some issues that we're not aware of behind the scenes, kind of an odd something like that. When rates have moved significantly higher, you can see right now that we're a little bit oversold, but it does feel like we want to come down and fill that gap. And I wouldn't be surprised to see us come down into this 15 area here where there's a ton of consolidation on RIVN, especially with that convertible note offering. Spotify also in the news, or at least in a lot of commentary on X, the old Twitter, etc. Lots of chatter about this. Nice update today on Spotify. Earnings report coming out. We've gone through a bit of consolidation here right at that 160 level, which was resistance back in June and July. We broke above it, came down and tested it. So perhaps there's some thoughts that Spotify is going to have a good earnings report and break to the upside, or maybe people are just looking at, well, we kind of have an ascending triangle here, and that means we could break either direction on this earnings report. So maybe the interest is about the earnings report coming, but when you have that on top of the fact that you're at a major area of resistance, I can see why people are saying, yeah, I wonder which way that's going to go. Also, in the mediaverse, if you will, was Bud, and it doesn't look like the whole Bud Light controversy is over yet. And we had that big, massive move in the area, and then we went through and consolidated for quite some time, a number of flats through here, and looked like, well, maybe we're going to kind of find a base somewhere in this area here around 55. Didn't happen. Broke below it and looking uglier. So it doesn't look like the controversy is over yet. We're in a wave 3 now. And again, in this wave 3, we could continue down to where this wave 5 is. We can run all the way down to 50 here before a bounce, or we could start the wave 4 at any point in time. And if we were to start it immediately, we would be right back up towards resistance there at 55, which kind of makes sense, but the markets don't always do things that make sense. So looking at that 55, perhaps if we were to get a bounce up there, that could be an area to consider a short position here. It's just the hardcore group that is anti-Bud Light right now seems to be flexing their muscles once again, and we could see further downside here. So I do think we see 50 on Bud. The only question is, do we bounce first and then go down there, or do we go straight down there before we get there? Netflix also of interest, and I think this one's really interesting. I do feel that we're going to have a recession. I have all along. I've never wavered from that. I know the media talks about a soft landing or no landing, and it's different this time. My experience, and I've been trading options for 27 years, is you never ignore the bond market. And the bond market, the spread is getting better, but it was, 100 basis points between the 2 and 10s multiple times. It's been inverted for over a year, and that's just screaming of a recession. So I don't feel like you just ignore that. When you look at a chart like Netflix, the wave 4 is right at that fib level of 61.8, the strongest of all fib levels, in my opinion. We're getting a little bit of a bounce. And if you want to look at something to try to take a shot to the long side there, perhaps Netflix is something you want to look at. Go back and remember when we had all the COVID stuff and everything, things were pretty ugly. Netflix took off. Well, if we go into recession and people aren't traveling, they aren't doing those kind of things, the chart of oil has come crashing down, basically. I think there's a limit to that, though, especially if you believe what OPEC is saying, that they're going to keep a floor under the price of oil. At any time, they could come in and say, hey, we're going to cut the price of oil. But if we do go into a recession, what are people going to do? Stay at home and watch TV, right? So I think you could make a case of the potential for a bid underlying Netflix, especially holding at this 61.8% level. So I'll say, as long as we can stay in that 380 level on Netflix, I think it can look long. If we were to break below that, then maybe you want to let that go. The next level of support's not that far down, around 340. There's more support there. But as long as we can hold above 380, perhaps you can take a long shot there at Netflix. Google, look at that move today. Again, as I mentioned in the very first part of this recording, that the AI stocks with the Qs are hanging in there pretty darn well. And so we filled this gap, and you wondered, well, is that going to be it? No, especially based on today. And remember that today we had a, quote, bad jobs report with the fact that twice as many jobs as expected were added, and yet significantly to the upside. And so when you look at this and you take a look at the DMI, which is not there yet, but it's trying to set up like it looks like another run higher, that ADX has to break above 20 first. But you're getting separation from the two directional indicators with a positive directional indicator on top. I think Alphabet is one to keep an eye on, but you want, if you're following that indicator, let that ADX get above 20 first. And it does make sense that kind of if Google breaks above this high that was created back here on the 18th of September, if Google were to break above that, we probably have had that ADX above 20, and that could be another long in the AI space. We were asked, and again, we do read your comments, so please keep posting those comments on our videos. We read them. Could we take UPS? And so here's the chart of UPS. It's in a wave 3 to the downside. I don't know why FedEx is viewed as being a little better thought of right now than UPS. Not quite sure why. You can see that we have a bit of a zigzag pattern here to the downside on UPS. Not much of a correction. Didn't quite make it to that 38.2% level. But nonetheless, we did go down to 100% extension in this wave 3. And the problem there is, if you listen to Elliott, he would be like, that could be one big impulse. The fact that we didn't make it to 38.2 on the corrective move. And so perhaps we are trying to consolidate here. Perhaps we get some sort of a bounce, but then after that, do we go lower? The algorithm, for whatever reason, likes a price on UPS stock around 140. So same scenario again. The question is, do we bounce and then go lower, or do we just continue to the downside? And if you believe the writings of it and his own personal observations, he would say that a continued move lower is possible. We do have a little bit of support being attempted to build in there. We'll see if that continues to hold. We are trading through the 10-day moving average, so we're not oversold anymore. So maybe we attempt to get some sort of a bounce here on UPS. We could bounce as high as 170 if we go higher, but pretty interesting. Yeah, you look at Amazon, etc., not performing too poorly. But why is FedEx outperforming UPS? What's going on there? You also ask us to look at CrowdStrike. So we are doing that. And what a day to look at CrowdStrike. Look at that move to the upside. So again, if you're looking for a potential position, a massive break there above this resistance area at 170. And you know the rules if you've been watching. One day doesn't mean anything. There's lots of head fakes in the market, although they're not usually this significant. But you want that follow through or confirmation day, and you can see that we traded through the 10-day moving average. So even though we closed well above it, we're not that far away from the 10-day moving average. So I'd say we're not that far over. I think crowd could continue higher. So good on you for looking at that. And again, that question was posted a few days ago, not today, based on last week. So a pretty good time to talk about it. So thanks for bringing that one up. And we may be off and running there. That's my analogy of clean air, because we really don't have any resistance up till 200. And so if we could get some follow through here on this move higher, I think we go up and retest 200 on CrowdStrike. So pretty interesting there. And to finish up this week's update, GLD, thanks for asking about that. Once again, responding to your comments from last week's video. And I have been watching both gold but taking a look at GLD. And if we do move higher, that 10-year relabeling to a wave 3 certainly is concerning in the whole metal space. We're at this last little bastion of support here on the GLD. We did have a little bit of a tick up today. It's trying to hold that 170 level. And we look at the moving averages, we're still a tiny bit oversold. But if we were to break to the upside here, then we could have a little bit of a move lower. And I would submit to you, we don't even need this break up towards the 4 because 170 is so important. If we break that, we're probably looking at 155. And at one time, I was trying to wait for an opportunity for the market to create a bid under the metals with the fact that maybe rates were topping out. Well, now that it looks like rates want to go even higher from here, we start to break higher on that 10-year on interest rates and break below 170. That looks like an awfully good short to me to the downside. Now, it has to occur first, so keep an eye on rates, keep an eye on the dollar. Those are the two key things. A little bit of a break in the dollar has allowed it to go sideways, but if that dollar continues higher, rates continue higher, awfully difficult environment for gold or silver, the metals, to go higher. And if we can break below 170 with follow through, then we have a pretty nice short trade there. Thanks as always for your attention. Have a great weekend, everybody. Next week, lots of things to talk about with the fact that the market is trying to hold support at 420. Can it do it? We'll be talking about that when we get together again next week. Enjoy your weekend. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.